We start today's market talk. Notwithstanding the uncertain global environment, the Indian economy sustained its growth momentum during the first quarter of FY27, supported by resilient domestic demand. And this is the key issue. This is the only thing one should focus because despite all the macro worries, the earnings of non financial companies support this contention. Financial is a separate game altogether. So that's what I said. Non-financial companies earnings are supporting this. And now we'll discuss this in detail. Firstly, rising crude prices have rippled through the economy, lifting the cost of fuel, freight, packaging, fertilizers, and industrial inputs. So now what was the impact? Let's start first with cement companies. Strong demand, they could raise prices, and there was revenue growth. But rising cost weighed on profits. Let's take examples. Ambuja and ACC impact on EBITDA per ton. It has come below 1,000 rupees per ton. Hope for reversal in second half have dimmed following resurgence of Middle East war. Then Dalmia Bharat, strong volume growth offset by margin pressure due to higher fuel and diesel costs. Next in this is fertilizers. Now, for the macro issue, the subsidy bill is expected to double for FY27 for the government. But if you see the earnings, Coromandel, earnings, the biggest player in this field, earnings declined 24% due to higher raw material prices. And okay, next in this industrials, L&T, the biggest one, revenue growth moderated in high single digits. It has retained guidance of 10 to 12% growth in revenues, which they said we will see what happens to it later. But right now, 37% of the order book is from Middle East, where disruptions continue. Now, you can say that the reconstruction of Middle East post end of the conflict provides a strong opportunity. So that is what is keeping this stock alive. And the order book. Order book is around 7.79 lakh crore, 7.79 lakh crore, which is 3.3x FY27 expected revenue. So that also, it affected their earnings. They were able to manage the margins better because of balance sheet control, cutting down cost, and selling off projects which were not working properly. Next in this is HEG. Now, major drag on demand is Middle East. They make these graphite electrodes. So decline in steel demand expected in calendar year 26. Surge in prices of crude oil derivatives like needle coke, etc., is likely to keep a lid on margin expansion. They have 20% of the business from Middle East. So there are certain businesses in this quarter which was impacted by the rising costs, input costs. But now what performed? Brand owners, they were largely protected in terms of their profits. First and foremost, Asian Paints. They have pushed through price increase while defending margins. Decorative paints volume growth of 9%. Rural demand is better. So they did well. Then HUL. Hindustan Unilever delivered strongest sales growth, top line growth of 10%, home care 14% sales growth, double digit growth in beauty and well being. Packaging material and crude impacted margins. But if you see the stock, FY27 expected EPS is around 48. So it is right now trading at around 42p. So at the lower range of its uh, historical P. Next, Colgate Palmolive, double-digit sales growth, gross margins expanded by around 110 basis points. EBITDA margins lower due to surge in advertising spend. So they have spent more on advertising, so the margins were lower. But if you see FY27 EPS is 52, they are also at around 41p. And demand for premium oral care products has improved. Then Radico Khaitan, 12% revenue growth, gross margins improved 610 basis point, 51% increase in EBITDA, and prestige and above volumes rose 35.9%. So they did well. Royal Enfield continues to dominate premium motorcycle market. Tata Consumer Premium portfolios continue to outperform volume growth 13%. So FY27 EPS is around 19.5. So they are at around 56p. Then PN Gadgil Jewelers, 41% revenue growth, same store sales growth 46%. EBITDA margins improved 120 basis points. FY27 expected EPS is around 36.5. So they are at around 18p. Still a lot of value. I think they are doing some kind of a QIP, etc. So the stock is coming down, but it will grow. And they are growing into other states now because they were a regional player. Then RR Kabel, 54% revenue growth, 17% volume growth in wires and cable. Just for reference, Polycab's volume growth was just 3 to 5%. Robust exports, FMEG achieved operating break-even, 100% EBITDA growth. So it performed much better than even Polycab. KA results have yet to come, and its FY27 expected EPS is somewhere between 62 to 68. So even if you take an average of 65, it is trading at 40p. So all these people who have strong brand recalls, they have been able to do well and retain profitability. So there is no kind of a bad earnings from all the stocks where the brand recall is strong. Then investment remains broad based. Now where is the investment taking place? Tata Power continues to invest in generation and renewables. They are doing around 25,000 crore capex. NTPC is expanding capacity, added 1.8 gigawatt, and 35.7 gigawatt is under construction. So all the related companies will do well. BEL, there is a record order book of 72,000 crore, and they are, which is around roughly 3x FY26 revenue. Coal India diversifying into coal gasification and cleaner energy. Now, MTAR capacity expansion, they are doing that, and their order book is 5x revenue. They would do roughly around 80 odd rupees of EPS in FY27, so they are at around 71p. So not bad with the kind of growth they are doing. Then auto component makers, they are moving into semiconductors, aerospace and defense because forging capacity requirement is the same. So the stocks like Sansera Engineering, Craftsman Automation, Bharat Forge, etc., good earnings, good and strong earnings. Now let's go to Indian IT services. The question is, can AI-driven revenues offset the slowdown in traditional outsourcing? Now, examples here. Coforge, 33% revenue growth, 86% of the revenue came from AI-led engineering, data, and cloud services. EBIT margins at 16%. They launched Neuron, an AI operating system designed to integrate enterprise knowledge, governance, and workflows. So the stock has nearly reached 1700 now from 1400 after earnings. Fractal Analytics, 20% revenue growth, EBITDA margins improved to 15.7%. There is a concern over technology, media, and telecom vertical of their businesses, but it is at around PE of 36 for FY27. It will benefit from increasing enterprise AI adoption, strong client mining, and disciplined execution. Healthcare and life sciences, banking and financial services and insurance doing well. Consumer packaged goods and retail reported strong growth. So all the other segments are performing well. So in terms of IT services, if you see, the mid-tier IT services companies have shown that AI is beginning to generate new business opportunities. Hence, the mid-cap IT companies which are specialized in select sectors like Coforge, Persistent, and Emphasis are doing well and are reporting strong earnings. So next few quarters will answer whether AI-driven revenues can offset the slowdown in traditional outsourcing. On the other side, if you see the company which is related to the AI and the business and the stock markets which were related to AI, like Kospi. You see, Kospi, it had plunged roughly 34%. It rebounded. This is a daily chart, so it rebounded on Friday once there was some AI related rally in the US. So it bounced back roughly 17-18%, but it is volatile, right? So, and because of that, so if you see the Nifty IT, it made the low there somewhere around 26,000, and then it has bounced. It bounced around 19% from there. As investors are now focusing on enterprises which will deploy their AI. Now, what has happened with this IT? It has bounced back after some good earnings, and the valuations becoming very attractive, and it has now reached a resistance which was at 32,000. It will go back maybe somewhere around 29,600 odd, which is this support 20 EMA, and then we'll see how the things go from there. So what is the sum which is coming out of this is companies with pricing power, premium brands, AI driven productivity gains, or exposure to the investment cycle continue to perform well, and those dependent on commodity inputs, pure volume growth, or global supply chains face a much more difficult environment. So this is the basic theme which is emerging from earnings till date. Now let's come to FIDI data. So if you see here, FIs are net short on index futures. They added longs on Nifty, sold index call options, and bought index put options. So they are medium bearish, though they have reduced their short positions, which I'll show you next. Professionals or proprietary traders sold index futures, bought index call options, and bought index put options, which are more than the call option. So they are also medium bearish. Clients, they have sold index futures but remain net long on index futures, sold index call options, and sold index put options. So they are with these roughly around 7 lakh put options which they have sold, they remain strongly bullish. If you see from in terms of this week's data, this week the FIs, when they started, they were short 2.71 lakh positions. Despite there was an expiry also, and after that, even after that, they have not added short positions. So this week saw full on short covering. So all 5 days they did short covering, and now the short positions are 1.73 lakh in terms of index futures. And so every day the markets have moved from below 23,800 to now roughly 24,384, and it was positive on all days with other actions in options also supporting this action, and there is cash buying also. So there is a change in the FI behavior. Now coming to the US, what happened in the US was indices moved higher. Fed held rates, so the 2-year yield came down, which was going up because it was worried about that Fed may hike rates. But if you see, the 10-year yield is moved up because people are, and the bond markets because of this have sold off, because as 3 FOMC members dissented while presenting a 25, while preferring a 25 basis point hike. Though there was no hike, but they wanted a 25 basis point hike because of inflation. And US 30-year yield has climbed to 5.28, highest level in 2 decades. Now the dollar index corrected on concerns that Fed will not move forcefully to contain inflation. So people have sold off the dollar. And also it was supported by efforts by Japan to shore up yen weakness. So that added to the pressure on the dollar. So as the dollar corrected, it supported the rupee. Brent crude is moving as per the news. Now it's somewhere around 90 odd dollars, but on Monday it should fall. Gold, if the rates are going to go up, gold will correct. Right now it is consolidated around $4,000. But once it breaks this support, it may head lower and test this 3,400, 3,500 area from where the rally has started. So one has to be slightly careful here. Similarly with silver, the support is at around 50,000. But we'll have to see what happens from here, because lower interest rates are negative, higher interest rates are negative for gold, silver, and cryptos also. So they also corrected around 3.77% last week. Copper was positive on expected higher demand, etc. So S&P 500 was up 1%. Nasdaq was up 0.5%. It recovered. basically because Amazon and Microsoft surged upwards because of good earnings, while Apple corrected. Hence, the because it was earnings related move which was taking place, which was supporting S&P 500 and Nasdaq. So we'll have to see how the future earnings play out there. And Dow was also up 1%. Now coming, so if you see, as I mentioned, the Indian rupee strengthened, so it came down. So that should be good. And now there is a statement that in till July, I think $40 billion have come in terms of total deposits in FCNR and others. So that should also relieve some pressure on the rupee. The government bond yields went up because the US yields are going up. So the Indian yields are also rising because of that. So it went below this declining trend line, but has bounced from there. The most surprising part is India VIX. It has come now below 12. So it is what it is showing is some kind of complacency now. So there's a lot of put selling oblique call buying which is taking place, and because of which the VIX has come down a lot. But this is not very healthy as such. It is not really pricing in the risks adequately. Now Nifty, it was up 2.59%. Strong bullish candle, and it is trying to break out. So if you see the daily chart, it has moved on all 5 days, and now it is just poised. It went above the 200 EMA, which was providing resistance, and now it is just stuck there. So once if it goes above this, then it should test this high of 24,600, and then it can move to 24,900, 25,000, etc. Support should be at this range of 24,130, 150, and 24,000. So basically, last week it was led by IT and autos. So if you see here, auto index has moved up 5.61% last week. Who was leading? Mahindra and Mahindra, Ashok Leyland, Bajaj Auto, etc. And now it will spread. So one has to watch for this level, the previous high, and once it goes above this, we should see a breakout here. So 26 above 2600 was where it took a strong support and broke out from. So that it is doing well. Nifty Bank, to see nothing much, a 1% move. It was in a consolidation phase, so you see it's not moving anywhere. And on the daily chart also, it is below the 20 EMA. So it was consolidating for the whole week within a range now. So the resistance is somewhere around this 57,600, 57,700. Above this, it may test this 58,500 and then 59,000. And support is at this level of 56,500. So that is what it is. Midcap performed well, was up 2.41%, now trying to go to fresh high. Similarly with small caps, around 1 or 2% from the all-time high. So let's see if next week is good, and the broader markets should perform as the earnings are strong. The reason for the weakness in Nifty Bank was HDFC Bank. It just consolidated, not much movement, but it has taken support at this 720, 725 range. So this has been traditionally providing support. So let's see if it can take it out. And Reliance, it is below all the moving averages, somewhere consolidating in this 1240 to 1300 range, but it has to cross this 1310 for some strong momentum. So if you see in terms of IT, Persistent, HCL Tech, Tech Mahindra, Coforge are showing strong up move. In terms of other stock, Eternal gave a good move, but now it is correcting. So 290, 285 should be a decent support to again get it. And Bajaj Finance comes to around 1100, 1075 can be bought. Now I'll cover two stocks. First is Swiggy. Now what happened with the earnings was that the food delivery gross order value grew 17.4% year on year, impacted by higher restaurant-led cancellations due to LPG-related disruptions in the early part of the quarter. Despite this, the management reiterated its 18 to 20% GOV growth guidance. So it is below their guidance, but they are saying they will achieve that. Instamart reached contribution break-even. Now, what is contribution margin? What it evaluates is profitability at individual order level before factoring in the overheads. Means it what is basically means that individual orders should generate cash after paying for product, dark store operation, and last mile delivery. Healthy platforms target around 5 to 10% as a contribution margin of the GOV. So what they said is that more than 45% of the stores, the contribution margin is positive versus 30% in Q4 FY27, and 5 of the top 7 cities turned contribution margin positive. So that means on every delivery they are making, they are saying that they are making some cash. Management will prioritize growth over near-term profitability, which is known because the hyper-competitive environment, accepting around 100 basis point contribution margin dilution to accelerate store expansion, improve customer experience, and drive higher user acquisition and purchase frequency. Now, Instamart is operating in 131 cities with 40% store utilization, providing significant room for operating leverage. Customer retention also strengthened with 1 month retention improving to 61% from 55% in Q1 FY26. Quick commerce monetization continued to improve through higher brand take rates, advertising, and user fees. The out of home consumption business has reached an annualized GOV run rate of 6,000 crore with an adjusted EBITDA margin of 1%. Management expects this business to exceed 10,000 crore in annualized GOV over the next 2 years while generating an annualized adjusted EBITDA pool of 500 crore. Board has approved a proposal to cap Swiggy's aggregate foreign shareholding at 49.5% to qualify as an IOCC. IOCC is Indian owned and controlled company. So what advantage it comes like eternal? They can shift from marketplace to a direct inventory model and sell their own brands through their network. So this is what they are saying, but the net result would be there would be MSCI selling because they will have to reduce the stake because the foreign shareholding has reduced. But the main point is PAT will remain negative due to persistent quick commerce dark stores network expansion, technology stack investments, and customer acquisition costs. Now, if you see this quarter's earnings, the net sales quarter and quarter is no point seeing it year on year, grew 6.7%. So, which is decent, and for the year it grew 37%. The food delivery, if you see gross order value for a year grew 17%. The expectation was 18 to 20%. If we see contribution margin, though reduced, but it is 7.6%, so that is good. The Instamart GOV is roughly 7,900 crores, grew around 39.8%, was expected to grow around 50%, and contribution margin has improved. So they have reduced their losses. So it is just minus 0.2%. So, and even the adjusted EBITDA as percentage of GOV has improved. So they have tried to reduce their losses. Now, key performance indicators in food delivery: average monthly transacting users. What is a monthly transacting user? It is guy who gives at least one paid order in a month. That's it. So they are roughly 19.2 million, 1.9 crores, right? So restaurants are generally the same level. So gross order value is roughly around 9,490 crore. This is in millions. And gross order value to MTU is roughly 4,943 rupees. Now, if you see QC business, orders are improving, total number of orders. Average order value is somewhere was lower, so that has reduced. Number of dark stores, they have been increasing, so that they would have to go up. So orders per dark store per day is generally the same level, and the size of the dark stores, they are increasing just to add more capacity. So if you see in charts, The GOV food delivery, GOV has been rising, gross order value. Now it has reached 9490 crore. Contribution margin is somewhere now 7.5% plus, not falling. Average monthly transacting users are improving. Adjusted EBITDA margin as a percentage of GOV is above 3%, so it could be better, and this will drive the profits. Average monthly active food delivery restaurants, now they have roughly 266,000 or so, that they have reduced. In terms of quick commerce, the GOV was generally static in terms of total amount. Contribution margin has improved, so the losses have reduced. Instamart average order value is around 691 or some, it has reduced. And adjusted EBITDA margins as percentage of GOV has improved, so the losses have reduced. Average monthly transacting users have improved 13.5 million, so roughly 1.35 crores. And dark store numbers have improved. So this is what is the customer acquisition, and addition of dark stores is the one which reduces the margins. Now, if you see the basic FY27 earnings estimate, so what they are estimating is roughly 20.2 million, 2 odd crore monthly transaction users. Now, what they're saying is each one will give 3.8 orders. So you multiply that, it comes to roughly 77.4 million orders per month. So orders per year, you multiply by 12, which is 929 million. Average order value is 436. So that's what it is considered. Say it should be around 436. So the total delivery GOV, you multiply 929 by 436 will come to around roughly 4 lakh millions, or roughly 40,509 crores, and take rate is 22.7. Take rate is percentage of GOV that of FD platform retains as revenue. So the revenue would be 22.7% of the delivery GOV. So it comes to around 9,187 crore. So this is what they will earn from revenue they will likely to earn from food delivery. Then they are expected to earn from Instamart roughly 7,025 crores and 529 crores from out of home consumption revenue. So total roughly 30,000 crore of revenue is expected in FY27. So the sales change is roughly 30% growth over FY26. The EBITDA, though, will be loss roughly 2,300 crore, and profit loss will be around 3,000 crore, but it will be still manageable because that kind of cash they have, so they would not be required to really raise capital. Now coming to one SOTP valuation with one of the brokers has done. So if you see, food delivery is 220, other businesses and cash comes to around, so total comes to around 269 odd, and quick commerce is 82. So that's what I said, around 260, 265 when the stock was there. The quick commerce business was, Instamart was not priced, and that is where the movement is now taking place. So if you see here, the stock somewhere around 230, 240 was underpriced, it moved up, and then from once it reached 265 odd, the realization come that the market is not pricing in the quick commerce business, and then it has quickly moved to 300. Now this is the resistance, so it will consolidate here, come down, and then again we should start moving. So let's see till what level it comes down to, and then again the rally should start. In my opinion, over a period of time it can easily go to around 350 because there is a value here. So the next set of resistance would be somewhere around this level of 307, which is the 200 EMA. But it can always go up. The other advantage to it is that the eternal market cap is around 2.91 lakh crore. So what happens is, generally the revenue and all is 1/3. So it can easily trade at around 1 lakh crore market cap. Right now the market cap is around 78,630 crore. So if you see from the market cap point of view, it is slightly below one third of Eternal. Now, the next stock is KFin Tech. It is historically known as a registrar and transfer agent, RTA. RTA, what it does is they basically do a record keeping of the mutual fund transaction processing, and investor service. It has transitioned into a global SaaS and fund administration engine spanning domestic mutual funds, alternative investments, corporate registry, and international fund operations. So from RTA, it is transiting now to a global SaaS and fund administration player. Now I'll show you how it is doing that. 32 to 33% of the domestic mutual fund average AUM and it services 31 out of 59 AMCs in India. So roughly the market share is one third. The balance is with CAMS. It is a clear market leader in corporate registry, servicing over 50% of the NSE 500 companies and holding 43 to 40%, 4% market share in main board IPO processing by size. So in a corporate registry, the services they provide are share transfer processing, dividend payouts, e-voting, corporate action administration, and shareholder management platforms. So roughly in this corporate registry, they have 50% market share. Market share of 39% in alternative investment funds, AIFs, by number of funds served. Then in NPS, they serve as one of the three operational central record keeping agencies, CRAs, alongside CAMS and Protean. Market share in total NPS subscriber base expand above 11%. Now, what they're doing is they recently acquired a Singapore-based fund called Ascent Fund Services. So they are trying to grow by organic wins in Southeast Asia, Malaysia, Philippines, Singapore after the acquisition of this fund. Why the earnings were subdued? Domestic mutual fund yield compression 2% sequentially was primarily driven by substantive asset mix shift from debt to liquid fund. So what happened is the margins reduce once people start shifting from debt to liquid funds. So it accounted for 30% of the yield impact. Then issuer solutions, where they are doing the corporate registry work, the business remained tepid due to two structural drags. Corporate actions, 30% of the segment revenue have been running slow, with top tier IT services company notably skipping dividend declaration this quarter, and net new DMAT folio additions have deaccelerated despite ongoing IPO activity. So that's why that segment didn't do well. Ascent currently operates, which they have acquired, operates at significantly lower margin, but is likely to improve, led by scale, cost synergies, and large client wins. It has added 6 new USD 100 million plus fund wins. Ascent is targeted to reach double-digit EBITDA margins within the next 12 months and 3 to 5 years to reach parity with its overall margin profile. So what is happening is the India business is fully matured now. So there is not much of a growth which is likely to happen. Hence, they are diversifying into other geographies. NPS pension business turned EBITDA breakeven and now contributes 50% plus margin, and wealth management platform Empower Wealth won 3 new mandates. So if you see, you can divide their businesses. KFin Technology. First is the RTA business, domestic mutual fund, market share 32%. Issuer services, that is corporate registry, market share 50%. They help all these main board IPOs. Then alternatives and NPS, AIF share is around 39%, NPS CRA growth around 11%, and then international global expansion through Ascent acquisition. So these are 4 parts of their business. What the management has guided is that FY27 revenue growth should be around 18 to 20% and net profit growth of 12 to 15%. Management expects consolidated EBITDA margins to recover to 40% by Q4 FY27 as cost synergies and operating leverage scale up. So 18 to 20% revenue growth, 12 to 15% profit growth. This is what they are targeting. So if you see here, this quarter, if you see, 30% revenue growth, EBITDA growth was 7%, PAT declined 2.6%, and EBITDA margins declined roughly 856 basis points. Market was expecting worse, actually. And if you see FY27 reported EPS is around 23. Remember this. Now, segment wise, if you see growth, domestic mutual fund investor solution grew single digit 6.6, issuer solution 7.7, international and other solutions grew best 181 percentage basis point for year on year, but uh, Q on Q it grew around 7%. But this is where the growth is taking place and where the revenues are coming from. Segment contribution, but if you see now the segment contribution of domestic mutual fund investor solutions has reduced now from 74 odd percent, it has come down to 60, and international and other investor solutions has increased. So they are now growing this part of the business. Now, if you see the margins, total segment results year on year. So if you see, it grew around 5%, the margins or the EBITDA. The PAT, though, declined 2.6%. So the margins are stable roughly in the domestic mutual fund investor solutions. But in this international and other investor solutions, the margins are low, and this is 3.1. So here they wanted to make it to double digits. Earlier, because the size of the business was less, this was around 14%. But after that, once they acquired and now they are trying to grow this business, this is where the growth has to come. So overall, the margins declined because of this reason. And result contribution, so if you see, domestic mutual fund is providing 87% and international is just 2.3%. So because of the margins issue. So if you see, overall revenue surged around 30%, share of mutual fund RTA declined to 61% because the others, in terms of revenue, domestic mutual fund business margins improved this quarter, as I showed you, and RTA profit contribution is still high, 87%, because the international and other investor solutions, the margins are around 3%. So that is what it is. While issuer solutions is a stable business, nothing great is happening there. AUM market share is around 32.8%. The balance is with CAMS. Equity share in AUM is around 56.8%. SIP book market share improved to 32.3%, and international business AUM grew around 46.5%. But this is where they have to work hard, otherwise very difficult to justify this price. So what they are expecting is that roughly in FY27 they would do around 22% revenue growth to 1,594 crores, and EBITDA would grow around 18% and profit should grow around 14%. So to 395 crores, and they are expecting around 22, 23 times, 23 P EPS, sorry. So they are at roughly around 38 P. So if you see the chart, this stock had made a high. This is a weekly chart of roughly around 1500, 1600, and then has been on a continuous downward trajectory. It made a low of 800 odd, and then last week it went up by good margins after the earnings, because the earnings were slightly better than what was expected. But I don't think there is much of a growth prospect in this business. So if you want to get this, buy it somewhere around 800. But it's a kind of a safe stock, and don't expect much of growth, because you see the trend is down, and all the moving averages are also trending downwards, because PE is roughly around 40 times forward PE, and growth is around 10-15 times, which is they are projecting. Now how much will take place is have to see that. So I have finished. We will take questions now.
Tarun, what do you